Pledging a corporate life insurance policy as security for a personal loan triggers a brutal tax penalty from the Canada Revenue Agency. This specific maneuver creates a debt to the government that costs more than the loan itself. Welcome back to The Explainer. Today, we break down myth number 5 in our countdown of the top 10 life insurance tax myths. Business owners often view their company's bank accounts as an extension of their own wallet. If you built the corporation from the ground up, its assets feel like your personal property. That psychological blurring of the line between personal and corporate wealth leads to some of the most expensive tax mistakes in Canada. To see the trap, imagine your corporation holds a permanent life insurance policy. It has accumulated $500,000 in cash surrender value. Now imagine you want to buy a lakeside cottage for your family. You need a personal line of credit to make the purchase. Instead of draining your personal savings, you tell the bank to use the corporation's life insurance policy as collateral. The bank agrees and pledges the policy as security. Since the policy remains in force and the corporation never writes a physical check, you assume the transaction has no tax consequences. This assumes that a tax liability only exists when physical cash leaves a corporate account. Canadian tax law treats you and your business as two distinct taxpayers. A thick legal boundary separates personal finances from corporate assets. Subsection 15(1) monitors this boundary, applying whenever a transaction enriches a shareholder at the corporation's expense. The Canada Revenue Agency explicitly targets the use of corporate property as security for personal debts. In Technical Interpretation 2000-0002575, they state that this arrangement confers a direct taxable benefit to the shareholder. The CRA looks for the transfer of economic value, not just the movement of physical currency. Consider the market cost of a guarantee. What would an arm's-length third-party investor charge to put up $500,000 of their own money to back your cottage loan? They would charge a significant annual fee to compensate for the risk of tying up their capital and exposing it to your creditors. By providing this service for free, the corporation has handed you a valuable financial favor. The CRA calculates the penalty using the fair market value of that guarantee. At a commercial 5% rate, the favor is $25,000 per year. The CRA stamps that value directly onto your personal tax return as an ordinary shareholder benefit. This invisible collateral swap creates a very visible mandatory tax liability. This chart shows the $25,000 tax penalty stacking up over time. The CRA adds this value to your personal income for every year the collateral remains tied to the bank, creating a massive cumulative liability. This leads to a cycle of double taxation. The corporation used after-tax profits to pay the policy premiums, and now you are paying top personal tax rates just to use the policy's value. You are effectively paying the government a tax on phantom income you never actually received in your personal bank account. A maneuver intended to provide free liquidity ends up creating a self-inflicted annual tax bleed. If you must use corporate collateral for a personal loan, you must pay the corporation a commercially reasonable guarantee fee from your personal funds to neutralize the benefit. A more efficient alternative is to keep corporate assets strictly for corporate borrowing. Tools like a properly structured immediate financing arrangement allow the company to leverage the policy without triggering shareholder benefits. The Canada Revenue Agency monitors these boundaries closely. You should never mix corporate collateral with personal debt without a comprehensive review from a tax professional. If this breakdown helped clarify your corporate structure, like the video and subscribe for more insights. Leave your questions in the comments below. Next time, we are tackling myth number 6, and it involves a deep dive into the capital dividend account. Stay tuned.